Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about EPR Properties Quarterly Report. EPR Properties is a leading diversified experiential net lease real estate investment trust, REIT, that specializes in select enduring properties in the real estate industry. The company focuses on venues that create value by facilitating out-of-home leisure and recreation experiences, such as real estate venues, out-of-home leisure and recreation experiences. These include various types of businesses and services, including but not limited to movie theaters, water parks, trampoline parks, indoor climbing facilities, virtual reality entertainment centers, escape rooms, bowling alleys, laser tag facilities. EPR Properties stock price has increased by approximately 14.87% over the past year due to several key factors. A strong Q3 2025 earnings beat and raised guidance contributed significantly, with the company surpassing analysts' estimates and updating its full-year 2025 earnings guidance to a higher range. The renewed interest in experiential real estate also played a crucial role, as EPR Properties benefits from a resurgence in demand for leisure and entertainment venues. The consistent dividend payouts of $0.295 per share, offering an attractive annualized yield of 6.6% to 6.8%, have attracted income-focused investors, contributing to stock demand. Additionally, positive market sentiment and favorable macroeconomic trends, including the potential pause in interest rate hikes and declining treasury yields, made REITs more appealing to investors. The company's strategic investment and portfolio management plans, including disciplined capital deployment and a strong investment pipeline, particularly for experiential assets, have also boosted investor confidence. Furthermore, the recovery of the box office has resulted in an increase in percentage rent derived from EPR's Regal lease, indicating potential for future upside. Overall, these factors have contributed to EPR Properties' stock price increase over the past year. The primary drivers of revenue growth or decline for EPR Properties can be summarized into three main categories. Revenue growth is primarily driven by rental income from tenants, participating interest income, experiential segment revenue growth, increases in minimum rent and percentage rent, and the expansion of development projects and investment portfolios. These factors have contributed to a significant increase in revenue. On the other hand, revenue decline is mainly attributed to defaults by tenants on lease terms, reduced discretionary spending by consumers, elevated interest rates, and defaults by customers and counterparties on their obligations owed to EPR Properties. Additionally, the education segment has experienced a decline in revenue. The corporate/unallocated segment revenue remains stable, indicating no significant change in this area. Overall, these factors have had a substantial impact on EPR Properties' revenue growth or decline. Net income and profit margins. A shift in performance. The financial performance of a company has undergone significant changes between 2024 and 2025. Net income has increased by 34.7% to $208,032 in 2025, compared to $154,461 in 2024. This growth is also evident in the 3 months ended September 30, 2025, where net income rose by 43%. However, profit margins have shown a mixed trend. While net operating income as a percentage of total revenue increased by 2.6% from 83.3% to 85.9%, income before income taxes as a percentage of total revenue decreased from 25.8% in Q3 2024 to 36.9% in Q3 2025. This discrepancy suggests that the company's profit margins have become more volatile. The reasons behind these changes are multifaceted, involving various factors such as investments and dispositions, other income and expense, general and administrative expenses, credit losses, impairment charges, gain on sale of real estate, and equity and income from joint ventures. These complexities highlight the need for a nuanced understanding of the company's financial performance to accurately assess its overall health. The company is generating significant and increasing amounts of positive operating cash flow, with net cash provided by operating activities totaling $123,456 in the current period, a substantial increase to $323,173 in 2025, and further confirmed at $12.1 million for the same year. It is clear that the company's financial health is improving. This trend indicates a strong ability to generate cash from its core operations, positioning the company for future growth and success. Management is optimistic about the company's future, citing a positive outlook with no mortgage notes or receivables with past due principal balances. The focus is on long-term investments in the experiential sector, where the company can leverage its expertise and relationships to achieve sustained performance across economic cycles. To drive growth, management plans to invest in new markets, expand into experiential build-to-suit development and redevelopment projects, and provide mortgage financing to support these initiatives. The company aims to maintain a strong debt-to-equity ratio by effectively managing debt and exiting underperforming assets. Adequate liquidity is expected to meet financial commitments, with funding for investments coming from cash on hand, excess cash flow, asset dispositions, or borrowings under the unsecured revolving credit facility. The company has made several strategic moves through acquisitions and divestitures in recent years. Acquisitions include the purchase of a CAD-denominated mortgage note receivable secured by a fitness and wellness property in Winnipeg, Canada for $27.9 million CAD. On the other hand, the company has also engaged in divestitures, including the exit of an unconsolidated equity investment in an RV property located in Louisiana and the sale of a subordinated mortgage note receivable for $1 million. The company has a history of paying dividends to its shareholders. For the 9 months ending September 30, 2025, the company paid out $217,393 in dividends, compared to $209,193 for the same period in 2024. The declared cash dividend per common share was $0.885 and $2.635 for the 3 and 9 months ended September 30, 2025, respectively. This indicates that the company has a consistent policy of returning value to its shareholders through dividend payments. Concerns about inventory buildup and supply chain disruption exist. The company faces 2 significant concerns that could impact its operations. Firstly, there is a substantial inventory buildup of $20.2 million in undeveloped land, which may lead to financial burdens and reduced liquidity. Secondly, supply chain disruptions are anticipated due to potential tariff increases on imported construction materials, posing risks to project timelines and costs. These challenges underscore the need for proactive management strategies to mitigate their effects. That concludes the financial summary for EPR Properties. Feel free to comment below, and I will be happy to answer them when possible.